Feel the beat, the future's near. Mind is fine, lose the fear. Hands up high, let's celebrate. In this groove of fate awaits.
Please remember that nothing we say here should be taken as personal advice. The conversation is for entertainment purposes only. If you have questions about your financial situation, please talk to a licensed financial advisor. All right, welcome to another episode of Future Money, where we talk about the investments of the future.
That will make us money.
All right, happy September. Thankfully, post September 11th now.
Yeah.
September's been an interesting month.
I know, it's crazy, right? Like yesterday, watching all the memorials and stuff going on.
Yeah.
It's there's no better way of like understanding how time moves than like seeing events like this. Because I remember vividly September 11. You know,
I think we all knew it's one of those flashbulb memories where you know exactly where you were, exactly what was happening. I mean, I just remember watching the news for like 48 straight hours. Like I just did not move from the television, you know. But thankfully we're, you know, long time removed from that. Obviously it's always good to remember these things.
Yeah, a little tribute to, you know, the 3,000 plus people that passed away or died in that day. But also, I watched 60 Minutes on Sunday. And they did full hour on FDNY, the fire department in New York, and like how heroic those guys were. Yeah, it's truly something that people should watch. You know,
absolutely.
You know, there's a lot of heroes there. So
and remember that, you know, what we always try to have a positive spin on this show is like think about how terrible things were at that time. And the months. You know, following that, and you know what, whenever you feel. You know, whether it's watching the debate or, you know, some random thing that happened to you, like it's good to have perspective of where we were, because we always feel like we're living in the worst time. Even though it's definitely not that.
That's a long view, right? Being able to come out of it and just see of the long term how things are, you know?
For sure. So let's talk a little bit about September and kind of what's going on, you know, in markets.
So seasonality, September is usually the worst month in the market. We're just coming out of summer, right? Doesn't feel like it's still summer in LA.
I mean, it did go down from 100 to like 75. There were clouds today.
That's true.
You know?
That's true.
There are clouds today. So the heat broke here.
But this is why we pay all the big taxes, right? Because LA is awesome right now. You look at, you know, what's happening in Alabama and Florida and all the disasters there. So,
well, we did have some fires, and
that's true. That's true. Yeah.
That's becoming a big issue.
Yeah, right. Lake Arrowhead. That's right. But September seasonality. September is always a tough month. Last week was one of the worst weeks we've had in 2 years in the market. And really, there is no real news that's driven it. Earnings have come in.
The labor reports, again, you know, I honestly, like, we've been doing this, you know, you're probably 16 years now. I'm like 14, almost 15 years now. Actually, 15 years now that I say it. My first, September 11th was my first day on the job.
Oh, wow.
So September 11th, 09.
This week is your 15 year.
So I was like heart of the financial crisis and in September 11th. So like for double
whammy.
So actually yesterday was my 15-year anniversary.
Happy anniversary, baby. We got to do something after this.
What's the 15 year? Is that like silver? No,
paper?
It's like copper. I don't know. So I need something copper. But you know, it's been 15 years now. You kind of see all these things happening. The worst, you know, we had these labor numbers, we have these inflation reports, like we are so overly obsessed with every data point. And it's funny because yesterday was there was a CPI print yesterday? I think it was yesterday, right?
PPI print this morning.
And they're like, and you know, the inflation numbers are this and that. And it's like, I was watching CNBC and they're like, well, you know, you could find anything you want in this.
Right.
There's weak points, there's strong points, there's mid points. Some things were better than expected, worse than expected. It's just like we're so overly focused on these things. And it's just like, the economy is fine. It's slowing, but it's not stopping.
Yeah, I think, listen, it's yes, financial media is trying to figure out and trying to get headlines. But ultimately, the most important thing is the economy is slowing down and the Fed is going to cut rates, right? And that's kind of what everyone is trying to telegraph. Is it going to happen in September? Is it going to happen November? Whenever?
Well, I think everybody knows it's going to happen in September now.
Correct.
Right? But honestly, like in your 15-year career, prior to the last 2 years, when inflation really like started spiking, do you remember in your whole history of doing this, so much attention to CPI numbers, PPI numbers, labor force. Like, but the governors like sneezed, and Fed governor sneezed, and somebody.
But
said
to be
something.
fair, we also haven't seen rates this high. Right,
that's true.
You know what I mean.
That's
so
fair.
I think that's really why, and inflation being this high, right? So I think the focus on the economic news is really just people trying to figure out what interest rates are going to go.
But what was the actual inflation? This is what killed me when I'm watching the debates and things like that. And again, I'm not taking a side here, but they kept talking about inflation and how bad inflation is.
Right.
At no point, because Trump kept attacking Kamala about this, but at no point did they say, inflation is like 2% right now.
Yeah.
Nobody said that.
True. Yeah, listen. Politics are about telling your own story, right?
Totally, but if you're on the defensive and somebody's ripping you for inflation, wouldn't you say, by the way, inflation's 2%?
Right. And also selecting different time frames, right?
Yeah.
Like 2 years, 3 years, 5 years,
Exactly.
so it's I think what we know, and we GK, we are investors. We're making decisions for our clients, for ourselves, to make sure that we make the best decisions, right? So we rely on facts and real numbers, right?
Yep.
Inflation is coming down, and it's coming down quite a bit.
Yeah.
Housing is really the only thing that's
the
sticky.
big problem.
That's sticky,
sure.
right? And it's really not. It's not a problem of It's a problem of supply. We just don't have enough homes, right? And this is a problem that's been going on for 15 years since the financial crisis, right? So I think the reality is, until we have some kind of resolution there, we're going to see housing prices, stay sticky like this.
Yeah.
Rates are coming down. Are going to be very helpful to mortgage rates, right?
Absolutely.
So, which will help housing, right?
Energy costs are down.
Yep.
Food costs are flat.
Correct.
So like
Correct.
all the pain that we felt, we have as people, we have recency bias. It's like, we felt this pain the last couple of years of prices rising. But if you actually go to places now, I kind of joke because I took my kid to McDonald's. Yeah, I know I did it. I know people in Santa Monica would be very upset.
I'm going to judge you, man.
But the first time I noticed inflation, I've been to McDonald's at least twice over the last 3 years. But I think I've told you the story before where my first run-in with inflation was in the end of 2021 when I went on a road trip and we stopped at McDonald's to get breakfast sandwiches. So 2 breakfast sandwiches and 2 coffees, and it was like $18. And I was like, what? And that was when I was like, okay, we kind of have a problem here. Well, a couple weeks ago, I went to McDonald's and it's all deals now.
Yeah,
it's all like slashing prices.
Yeah, I think McDonald's brought back the $5
menu. The meals were all cheaper. So there's definitely like people understood, like the companies understood that they can't just like raise prices 10% a year. And have people be okay with it. And we're seeing it at Chipotle. We're seeing it at all these companies that are kind of bringing this stuff down.
So that's great news for the economy. And also, I think we talked about this before, but our economy in general, the U.S. economy, is really the pride of every other country, right? Like, or not the pride. People look at us with envy because we have such a strong economy, but different sectors of the economy have had their challenges over the last 2 years. And I think now that slowing down is showing up in more consistency across the board, right? Doesn't mean that we're going to see this hard landing. I think the soft landing versus hard landing story is playing out, and it's definitely looking like we're going to have a soft landing, which just means that no recession, just things slow down a little bit and rates get cut. And hopefully things going to pick up a little bit after that.
Yeah, and so the rate cut cycle is starting. Hopefully, next week. The Fed has basically said they're going to cut. So the question just becomes how much, how many times. I think Powell he errs on the side of caution. So, I'm not in the 50 basis point camp because I don't think he's that bold.
I mean, listen, you're absolutely right. I don't think so. And plus, it is an election. He doesn't want to appear like he's partisan in any way, And frankly, you can criticize the Fed or not, and you can have your opinion, obviously. But at the end of the day, they've told us what they want to do for the longest time. We know what's happening, and they don't want to really surprise markets. I feel like if they do a 50 basis point cut actually may spook markets.
May spook the market that things are worse than.
Correct, exactly. So, so with that being said, I think it's interesting to see that rates are actually more important than the election, right?
Yeah.
People are, everyone. I mean, I get a lot of clients asking me, should I sell my stocks before the election? Blah blah blah. You never want to do that. That is not how you manage money. That is not how you invest for the long term.
No.
Elections do matter on the short term. They don't matter on the long term, right?
Right. And use it as you have volatility, use it as a buying opportunity. That's 100%. What we always say, right? We've talked about this on this show countless times. Like the market does not care whether Trump or Kamala Harris get elected.
Right, exactly.
They just care that we're past it and there's a smooth transition of power, which is a different issue.
Right. And I think whenever you find yourself using your emotions to make decisions around your money, then you're probably making the wrong decisions. So,
Correct.
Correct. So I think that's really what you have to kind of keep.
And we talk about this all the time. This is one of our biggest values, is being the emotional, being the money psychologist.
The sounding board.
I always refer to myself as the financial therapist. And that's a huge part of what we do, in addition to just picking investments, obviously.
Correct.
So we have some seasonality, September, October, especially when elections happen. But that being said, all the stuff we just said, I think the S&P is like 2% away from its high.
Yeah, it's just, listen, volatility is really what it is, right? Like the up and down. We haven't seen 1% move all year, you know what I mean, until last 2 weeks or 3 weeks ago, right? So I think the reality is you've seen this volatility pick up, and whenever you see that, it just creates more emotions around markets, right? But you're right. If you go a month or 2 months, we're basically where we were. So it's now like it's just a lot of gyration for no reason per se.
Yeah, remember the Japanese yen carry trade?
Oh yeah,
that seemed like it was ages ago.
Right.
And that seemed like it actually didn't even really happen anymore. So yeah, I mean, use this as an opportunity. As far as October also tends to not be a great month in the markets. So and markets are still richly valued. So it's not like we're there's no bargain. There's not a lot of bargains, I should say.
There was some bargains last week, and
and for like a day,
they were gone.
You had Broadcom, sell off 10%. Nvidia sold off 20%. And again, Jensen Huang sits down, has a conversation with Goldman Sachs, and the stock's up 10%.
I mean, listen, I listened to that conversation.
He's so good.
He's so good. This Jensen Huang is the CEO of Nvidia. If you don't know, and he talked about the opportunity of AI and like what could happen, with AI being a companion to help with productivity. And he talked about engineers having, a digital companion that can augment your
100
tires.
Basically, every engineer will have 100 digital coder assistants. Basically,
well, is
that crazy?
But he actually broke it down. Like it's actually numerically like this is why you have 100x augmentation. So
and one of my favorite quotes. He literally said, "There is not a software company that is not using us. There is not a tech company that is not using us." I was like, damn.
He actually even said, our customers are a little anxious because we can't give them all the chips they want.
Which brings us, and I think this might be a show for next month. Given what's happening with Google and what's happening with, now there's probing and thoughts of Nvidia as monopoly. So I think we should do an episode about antitrust and monopolies and what it actually means.
Lena, we're coming for you, baby. Let's do it.
But not to get too far into Nvidia, it was a great thing. We talk about Nvidia a lot in this kind of, but we're going to talk about something completely different this time.
So let's kind of break it down. We're financial advisors are about asset allocation, and you can invest your money in different things: cash, stocks, bonds, fixed income in general. There is treasuries, there's munis, there's all these things. But private investments have been something that a lot of usually higher net worth individuals are involved with. So today we wanted to kind of do a little breakdown of private investments. You and I have the luxury of dealing with a lot of high net worth individuals, and we see kind of the other both sides of the story, right? So we want to have a frank and really candid conversation about what works, what doesn't work, your opinion, what and really break it down, and just so people can really understand what they get involved with, and really have a real understanding of what the risks and the opportunities are.
Sure. Yeah. I mean, alternative investments have basically become the shiny object for firms to tell their clients about, to get them to invest and make them feel special about something that you have access to that most people don't.
So the private or alternative investment is the same thing, right? And you're right. It's a shiny object. The whole premise is markets, public markets, stock markets are only going to give you 10 or 9% a year on average over the long run. So how can you go somewhere else and get a little bit more return than that?
Yeah. Or on the flip side, get something with less volatility, so to speak. And I think before we get into that, like, let's talk a little bit about like
risk.
Well, before we talk about that, let's talk about, when we're talking about private investments, like, what are the main classes of private investments in general?
Start there.
Right. Everybody knows real estate, right? That's probably the easiest one to think about.
Right.
Private
well,
investing.
I'm not talking about your home, right? Home.
Right. If you're investing, now a private investment can be anything from, you're buying a house, a rental property,
Correct.
right?
Yeah.
But, if we're talking about really like a private investment in your portfolio, a lot of times this will be like a real estate fund or, I've seen of all the alternative
mostly
investments,
private real estate.
It's mostly private real estate.
Right. So commercial properties, data centers, things like that.
Yeah,
right?
or even like, packages of residential homes, et cetera, right? But obviously data centers is the new sexy real estate thing. Real estate people haven't had anything sexy to talk about for a long time, and now data centers is like that thing.
It's been rough for the private real estate market last few years because of rates being so high, right? But that's the one. I think real estate is a massive sector of the economy. I think it's almost $9 or $10 trillion. So it's a really, really big.
And everyone knows real estate. Like I always say,
it's tangible, right?
It's tangible, and I always say, like, the stock market is mainly a U.S. thing,
right?
Like. Most Americans somehow invest in the stock market, whether it's through their 401ks, or through, company stock, or, they buy some stock on Robinhood, whatever the case may be. But we all do. Other countries, internationally speaking, you have an international background. My family's from another country. I go to Israel all the time. Like, they're starting to pick it up. But for the most part, people in other countries, like, real estate is a universal language.
Sure.
I have a building, I pay for a building and I rent it out, and that math is easy to work out.
Since the Greeks, basically.
Yeah,
it's been happening for a long time.
I imagine land ownership goes back to like probably the beginning of civilization.
That's exactly it. So that's kind of your biggest thing, right? But we have also, so we'll start from like your buddy who's starting a company and asking you for 10 grand or 25 grand, right? That's called angel investing, right? Angel investing is the riskiest of the riskiest of the riskiest, right? Anytime I've done anything like that, I've usually said goodbye to that money.
Sure.
You hear the story of someone invested $50K in Facebook or whatever and became $1 billion. That just doesn't happen.
I always thought it was like the one I always think about is with the scene in The Social Network, about Facebook, is when he goes into Peter Thiel's office to get that first 100,000 angel investment. That's the one that always sticks in my head.
So see, that gets glorified, right? Like,
absolutely.
I mean, but that doesn't. Such a
how many failed Facebooks were there for every Facebook?
1 in a million. Man. So so be careful with that, right? Like, you're basically betting on an idea, you're betting on someone, it's gonna probably change 300 times before it becomes anything.
Totally.
And that's usually people that have excess cash, they can do this, right? So that's number one.
I do see people ask, like, I get people asking me about this a lot, and it generally is your buddy or somebody somebody you worked with is starting a company, and it's a cool idea, and I want to be part of that cool idea.
Correct.
And that could be they're starting a data center business, or that could be they're starting a beer company, and I really want to be involved.
Right. GK doesn't get involved with any of these things. As a disclosure, don't come ask me for money. But that's really the highest risk that people do. Second is VC investing, venture capital. Venture capital is basically early stage investing. Companies that have an idea, have a product, probably, maybe not a product, maybe an MVP.
Yeah. And most valuable player.
Yeah. No. Minimum viable product.
There you go. Yeah.
So it's basically a mock-up of what the product, the app is going to be. Maybe it's not fully kind of baked in, but there is an idea, there is a team, you know, it's gonna be played out. Usually done by professionals. There's a lot of fun. You hear about Andreessen Horowitz and all the big VC firms.
And again, this is like a sexy, like, I'm gonna hit it big kind of thing. It's one step less aggressive than Angel, right?
Yeah, long term, right? Like, you know, the goal of most VCs have a target return of 30 to 40% on average, right? And they also invest in 20 companies. Correct. One of them is going to succeed.
That's the hope, right? It's kind of the shotgun approach.
It's like 5% success ratio, basically, right? So it's very risky too, right? Yep. And you just have to know what you're doing. You have to, you have to have excess cash. It's not liquid whatsoever, right? And this is actually the one thing that is connective of all these investments. That none of them are liquid.
Yes. The highest risk in all of these things is the liquidity risk.
Correct. Yeah. Liquidity risk just means that you don't, once you put in the money, it's not there. Yeah. Like it's done.
It's usually stuck anywhere from 5 to infinity years.
Correct. 5 to infinity, literally, right? Like, if you think of companies like Stripe, right? It's been around for almost 15 years now, worth $100 billion, but it's no liquidity. Right. So you made money, you know what I mean? But it went up in value, but you can't really take your money out. Like was SpaceX the same thing, right?
Yeah.
Like,
although
so
they do their annual buybacks.
They do, but not for outside investors,
no,
right?
Correct.
Yeah.
Correct.
So that's kind of things that you have to think about, right? Yeah. And after that, you can think private equity. Yeah. We hear a lot about private equity. They are the sharks in the room. Yeah. They're evil. It's you have to kind of
listen, like any capital market, everyone anyone can be considered evil depending on your point of view, right? Yeah. But private equity, frankly, they're there to make money. They're there to make a return. Yeah. And I think the difference between private equity, because a lot of these sort of terms get interchanged, VC, private equity. Yeah. I think the main sort of difference when I think about private equity versus VC is like private equity is looking to make an exit at some point.
So private equity usually will invest in a private business that is established. So it has revenues, maybe even profitable, has a proven track record, has a team, and the idea is to augment that business. They come in, they bring value through maybe better management, maybe help them scale, maybe whatever things that they come in.
Or just a big influx of cash.
So they
can go out, they can go out and scale bigger.
Yeah, and the idea is for them to grow that business for an eventual exit. That could be sell it to another company or do an IPO or things like that. And those guys usually have a 5 to 7 year kind of time frame. Some have longer time frames, but the idea here is, at some point, every business needs to have more resources, more cash, more money to be able to get the next level, plus some value in the form of like.
And they usually have a target return that they're looking for.
Correct.
Like they're like, this is the marker I need to hit.
It's in the 20s.
Right.
Yeah.
But like if I don't hit this marker, I need to make something happen to it.
Correct.
So they're generally more hands-on.
Correct.
More in your face in the business.
Exactly.
But this whole business, this private equity and we'll get to private credit and things in a second, has sort of just boomed in the last decade. Because it used to be, right, you used to just, I was a tech company, let's say, I was a software company, I have a product, I got my first investment, then I build my product out, and then I needed money. What did I do? I went public. Right. The going public was a cash generation thing. And so you got an influx of cash when you went public, and then you sort of scaled the business that way. Sure. Today we kind of see the opposite almost. Like the companies that go public tend to even be less successful. Right. So you're getting like VC, you're getting angel, and you're getting VC, you're getting private equity, and you're going to get private credit.
Well, I think it's a symptom or an effect after the ZIRP, the zero interest rate kind of area, whereby companies could raise money no matter what. So there was no need to go public. Going public is expensive. You have to actually do quarterly earnings reports. You have to be, you know, you have
a lot more scrutiny.
A lot more scrutiny.
And what we'll talk about in a second is, you know, I had we both had clients who had companies that went public. I talk to my clients about this. I go, you might think you're prepared for the volatility of a publicly traded company with a large portion of your net worth.
Right. And
chances are you're not.
You're not.
Okay?
Yeah.
Because even though valuations of private company can move or whatever, the valuations happen once every year, 2, 3, right? So in your head, nothing changes. It's worth that much, regardless of whether it's the truth or not. Psychologically, it's worth that. Right. Versus you see that stock move 5% a day, it's a lot harder. It changes your psyche.
So you get liquidity, but also you get the volatility that is involved.
And now there's an endless supply of private investment. So it's almost like IPOing. IPOing basically has kind of become an exit strategy for PE insiders, for private equity firms, for VC investors, or for employees working at that company. Right? You're an executive at, you know, what was the company that Google was supposed to buy? The Israeli company.
Wiz,
right? Like they were trying to do, you know, an acquisition by Google. I think it didn't work out, but now they're going to go public. Why? Because they need an exit strategy.
Correct. You know, you have employees working for you for many years, and at some point they want to cash out.
Yeah, they need some money.
They need to buy houses. They need to take care of their families. Blah blah blah.
That might be an idea for another show of IPOs and what they look like. We're still really dry on the IPO front.
We have
not recovered on the IPOs.
You know, what I'm hearing from my investment banking friends and contacts is that conversations are happening and picking up. But they're just not happening yet. You know, so
and I definitely think the rates coming down.
2025 is probably going to be a good year. Maybe even 2026. Right. Private credit is also another alternative for private investments, which is basically you're borrowing money instead of from a bank, from investors, right? This is actually took off after the financial crises and after all the regulation that were put on banks. So there was a lot of money that just went into these private credit funds, right? And they basically invest in smaller to private businesses and really give them some capital to be able to again augment. Usually they have no rights to manage the business or ownership rights per se. It's just you're just
getting a loan.
Exactly, loans.
For your business. And as such, right, it's generally tends to be a higher rate loan because it's a higher risk business.
Yeah, and you have a preference on the capital stack, so you're kind of on top, you know.
We just for real quick, right? If your company goes bankrupt, right, in that process, let's say you haven't gone public yet, but so you have a capital structure, as we call it, right? Company goes bankrupt. If you're a shareholder, a common stockholder, you get nothing.
You get nothing. You're out.
If you're what's called preferred stock, they have that.
If you have preferred stock, you might get something. You may get something after all the creditors are paid, right? So your employees, your creditors are first. Then you got, you know, some of the private credit people who are like first lien on the cap stack, and then maybe if you have a bank loans or anything like that, that gets paid first. And if there is anything left after that, maybe the preferred stock gets something, right? So again, I think the difference between all of these is where you sit on the capital stack, and if there is any issues with the company, it goes bankrupt, do you get your money back or not, right?
So you know, if you're investing in private credit, the upside is you have sort of dibs. If something goes wrong with the company, you're obviously getting a good rate of return. You know, you could get 12% or so for a private loan right now. The downside is if the business explodes to the upside, you get you get nothing.
Yeah, and that's exactly it, right? And then also the other thing is there is different private credit funds. It is non-secured, secured, right? So you have to understand the nuance there.
There's a lot of different things. All of these things have their own individual nuance.
Right. And I think what's happened over the last 5 years or so, because rates are so low, people have been pushed to all these private credit funds because they're offering a much higher rate, right? So it's really important that you understand the risk that involved with going into usually smaller companies, not a very good financial footing, that are borrowing a bunch of money, in a time of the economy is not very strong.
Yeah. So I think that's a great segue into what we're getting, right? Just to kind of round out, if there's any other sort of alternatives and things like that, you have like gold and metals and things like that. Those are
crypto.
There's crypto. There's all kinds of alternatives because ultimately the term is a broad term used just to talk about assets that are not your traditional stock bond allocation, right?
Right,
Cash.
Exactly.
But private markets in general is kind of where we're going to focus on, right?
Yeah.
So let's talk about that. Was a great segue into the risk thing, right?
Correct.
I think I have a little different perspective on the risk of alternatives.
Yeah.
We talked a little bit before. The biggest risk in all these private investments is liquidity.
Correct.
Right? Am I going to get my money back?
Right, exactly.
One of the things I tell clients when they ask me about alternatives, and I'm not saying alternatives are bad because they definitely can make sense in the right situation. But one of the things I tell people all the time is, are you prepared to never get your money back?
Right.
That's the first thing, because I have seen all the volatility in the markets, all the stuff that happens, recessions, financial crises, whatever. The S&P 500.
Yeah, you can always sell your stocks.
You can always sell your stocks, not just to sell them, but historically speaking, obviously we can't say for certain in the future, but historically speaking, the market always comes back.
Right.
Because you have 500 companies. Let's say you're buying the S&P 500. You have 500 of the biggest publicly traded companies in the world. Yep. What are the risks that all of them are going to go to zero together?
Yeah, it's very low.
That means the entire world economy has collapsed to nothing. Yeah. To which point I say to people, we got bigger things to worry about.
Sure, exactly.
So I have seen several alternative investments, private investments, go to zero.
Correct.
And that's a real risk. The risk of zero or losing half your money. And when I say losing, I don't mean a momentary dip in the value. I mean that you lost half of your money forever.
You can never get it back.
Correct.
Yeah, exactly. And that happens a lot in private markets. You're absolutely right. So that's liquidity, right?
Yeah.
Like liquidity and risk of going to zero, right?
Yeah.
This is why, I think most financial firms, and GK has very, very few or small allocation to private investments.
Yeah.
But most serious financial firm would never advise clients to have more than 25% of their money in private investments. Simply because, again, liquidity risk, you know, and the high risk of just going to zero, right?
Yeah.
Now some firms,
right, so that's credit. We got two risks there. We have liquidity risk and we have actual like
credit
systemic credit risk.
Yeah,
right?
yeah, exactly.
So, so that's one thing.
Yeah. Thirdly is fees.
Fees. That was going to be my next one too.
Man. Like
that's 3 and 4. Right?
Yeah.
The fees are generally very high.
Yeah, so let's talk about the 2 and 20 structure.
Okay, so this is, we haven't quite talked about, managing, hedge funds or private markets in general, VC.
Yeah, hedge funds is another one, right?
Right, exactly.
Yeah, hedge funds is
But sort of a traditional number that sort of the industry has agreed upon for some reason is 2 and 20, which is 2% management fee, meaning if you put, $100,000, it's $2,000 in fees.
Yeah.
And then 20% of the profits.
Right.
Now that could be depending on if they have what's called a watermark.
Right. Usually above a certain return.
Yeah.
Yeah.
Some of them are pretty low.
7%.
Some of them are lower than that.
Yeah.
Some of them are like, if we do better than 5, like I was looking at one recently that my client brought to me, and it's like, oh, they have to do above 5%.
Treasury?
Yeah, basically, yeah. And if they do above 5%, they get 20% of the profits.
Yeah. This is why hedge fund managers, private equity guys are really rich.
Yeah,
it's as simple as that.
So the fees, and they talk about all these fancy things and how amazing they are and why they're so great and all that. But a lot of times they don't perform as well.
That's exactly it.
And you're getting charged 2 and 20 regardless.
Yeah. So the fees are really, really important because you can make great investments, but you're paying, 2% a year, right? Compounded every year, right? And you're waiting for this for a long time, right? And then 20% of whatever gains.
Right, and let's say you made 10% a year, which is a respectable rate of return. Yeah. It's like 6% a year if you count the profit.
Exactly.
6 or 5.
Yeah. So you're basically the GP, general partner who's basically managing the assets is the one that's making the most money, basically, right?
For sure.
So I think that's something that we always look at when we think about these things. What are the fees are.
Right. And if it's an amazing investor and they give you great returns, then you're happy to pay 2 and 20. Yeah. But how many of those are there? They're few and far between.
Yeah. Second of all is really transparency, I think, for me. That's a big one, right? Like, you don't know. First of all, there is no valuations. You don't know how much these things are worth. I just personally went through a situation with a client where they had a lot of money invested in private investments, for 4 or 5 years, and we're just trying to figure out how much things are worth.
Right.
We just can't. Nobody knows. Because you have capital calls and you have things, and some managers will report this quarter, some 3 quarters. I'm 9 months into the year, and I'm getting valuation from 9 months ago. You know what I mean? So I think the idea here is that the managers do not make it easy for you to know what your investments are worth and so forth. So you have to kind of understand that part of the investment.
Part of the thing is and this is what a lot of alternative managers will pitch, is that actually owning private investments decreases your risk. And I always challenge them on this, because there is a real difference between risk and volatility.
Sure. Yeah.
Okay. The risk, as we talked about, a risk of going to zero is a true risk.
It's real.
Right? What's your private investment worth that you bought 3 years ago if we're not making updates to the valuation? Why would I get another valuation of my business if I know it's lower?
Exactly.
Right? So you have this idea that you're staying at the same level, but in reality, we know that may or may not be true.
Yeah, and I think their pitch there is they're managing your emotions, right? Because you don't see the volatility, so you don't make stupid decisions. But the reality, as you said, is not real.
Yeah.
It's just not.
And again, I tell this to clients all the time, and this is part of having us as the financial therapist, as I tell people, what scares people the most about the stock market is the volatility.
Right.
That, in fact, in and of itself, is the reason it's one of the safer investments.
Sure.
Because the volatility, because the volatility means you have specific, up-to-date price discovery.
Markets are pretty efficient.
And that means you can get out at any moment and know exactly what you're getting.
Correct.
Right? And so it's this weird conundrum where the quote risk, quote unquote, is actually what makes it safer, quote unquote.
Right.
Because you have this idea that you can get in and out whenever you want.
Right. Exactly.
Versus if I have a private investment that I bought 3 years ago and I want to get out today, let's say there is a way to get out today.
Yeah.
Who knows what I'm getting back for my money?
Right. That's true. What do you think? I mean, I think after breaking all this down, what's your view on private investments?
So I think there's definitely a place for it for people who are higher net worth, who are looking for an alternative. That's why we call them alternative strategies.
Right.
I think as rates come down now, I think for the last 2 years, when you can get 5% on a treasury bond risk-free, and you can get 7% on a corporate bond, investment-grade corporate bonds, why would I go to the super high-risk side of the portfolio, knowing I have equities too, to get 10%? You know what I mean? I think as rates come down, these things start to become more attractive again.
Yeah.
And I look at it as whether it's VC or private credit or crypto
or hedge funds.
I look at it as, think of this money as the part of your portfolio that you're comfortable, number one, holding for 10 years.
Right.
And number two, comfortable that if something happened and it lost half its value, you're okay with that.
Right.
And as long as you're okay with that, we can swing for the fences with this part of the money.
Yeah, and that's my view when clients want to get involved with this, is always like, this should be small part. Right. We should really look at the small print, understand the details. These people are very sophisticated, so you have to understand what you're buying, what you're getting into, and then make sure that it fits within your needs, right? Like, liquidity needs, transparency needs, and so forth, right? And as you said, sometimes you don't need to swing for the fences,
right?
You know what I mean?
Like, and most people don't want to swing for the fences. It is funny because most of the people I talk to, when we talk about private investments, I break down all the risks to them because we're fiduciaries. We don't care whether you invest in Apple, Nvidia, Tesla, or Joe Schmo's startup fund.
Right. And we don't get paid more.
We don't get paid more for that.
Yeah.
So I tell my clients, I'm happy to do this for you. Let's talk about all the risks that are involved. 9 times out of 10, they're like, I'm good.
Right. Yeah. Again, it's really about education. It's about understanding what you can.
And I think a lot of managers are selling these products.
Oh yeah. It's a pitch.
It's a sales pitch, and that is not what we do here.
Right. Exactly.
And yes, most people don't want to swing for the fences. They're comfortable with the risk they have already, and sometimes they're uncomfortable with that, even when the market goes down. So again, it's for generally a smaller group of clients who are comfortable with that risk. It's important to break down all the downsides, but it's important to note that there are upsides.
Sure.
Right.
Yeah. Yeah. I mean, listen, I don't say no to everything, but I'm also like very cognizant of, what's the pitch, what is the risk there,
Absolutely.
And and I hope so. We wanted to have this conversation because there is such a demand right now, and all these private equity firms are hiring all these, people, and they're pitching these products and so forth. So there's a lot of conversations around these investments, and you have, a lot of advertisements, and people are looking at all these, the fund rise and all these things.
The fund rise is really like, again, it's starting to put this thing on the map. I've had several people ask me questions about that. And again, it doesn't mean it's bad, but a lot of people are selling products.
Right.
Okay. That's why it's important to work with a fiduciary, whether it's with us or with your own advisor.
Right.
Your advisor needs to be a fiduciary, because we do not get compensated if you buy a private investment versus buy Apple.
Exactly.
Right.
Exactly.
So that's the super important part. And once you break everything down and you talk about all the risks and rewards of both things, we can all make an informed decision of what works for us.
Yep.
Happy to do it. Happy to say that 5 to 10% of your money should be in in a private investment.
Yep.
But just know what the risk comes with it.
Yep. Well, that's our episode.
Yeah.
I hope that was helpful. Obviously, we're here if you have questions, if you have comments. We'll
see you next month. What did we say? We said we were going to talk about some other...
Antitrust, baby.
Let's go.
Let's
talk about antitrust next month.
I love it. I love it.
All right, guys.
Cheers.
Cheers.